Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Micron Technology. We'll discuss should we pass or should we play? Hello, everyone. My name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Today, we're going to talk about Micron Technology. But before we get there, let's look a little bit about what's going on in the markets. I'm going to start with my VIX watch list, which we look at usually each week here on the Stock Play of the Day. And we see that actually the VIX, after having a run up yesterday, up around the 20%, well, beyond the 20% level, we've actually pulled back a little bit on the VIX. Now, to me, I feel like the VIX index being below 20 in this type of environment is a good sign for the markets overall. People are nervous about Fed rate hikes, and the real story this week is all about interest rates. So I'm going to highlight that, and that's going to be our main talking point here as we're looking at what's going on in the markets overall. But we see the NASDAQ right now is up about 1.4%. That's good to see some strength in the NASDAQ relative to the S&P 500 index, which is up about 0.5%. As I mentioned, the VIX index right now is down at 1884, which usually you have an up market in the S&P 500 index. Usually see the VIX come down. But I just think it's very good over, I'm going to say in general, it's a good sign that the volatility index isn't showing a lot of angst in the marketplace relative to what's going on with the interest rates. The chairman Powell is right now talking to Congress. They're having their meeting as he is getting set to do his next term as chairman of the Fed. So with all of that happening, to see the market be up around or having a good solid update today, VIX coming back down overall means a little bit of the nervousness has gone away. Now, here's what is making me nervous overall is that if we look at the interest rate index, the TNX, this tracks the 10-year Treasury, we see it at a high that we haven't seen in quite some time. It's trading at the interest rate is about 1.7%. And I actually have the chart of the TNX over here. And I want to highlight a couple of things on the TNX. First of all, we got to go back. This was April 1st, where we saw kind of the precipice of the interest rates ever since the pandemic and the downturn that we've had. And we see here that at this point in time, that was about 17.5%. So we've broken through that high that started the last time that we were there would have been January. Where is this exactly? About January of 2020 was the last time that we were at that rate. We finally broke through that. So interest rates are now in a different territory, if you will. And I do have a line in the sand drawn. That's at the 2% level. And once we broke, and it's really interesting just overall how humans react. It seems like the 2% level, these nice round numbers have a tendency to provide support and resistance for no other reason besides the fact that they are just a nice round number and people are looking at those numbers overall and talking about them. So we did see that here. This goes all the way back to August of 2019, the first time that we broke below the 2% level on the 10-year. And then it fell hard. The marketplace overall, as far as interest rates were concerned, came back up and tested it, came back down. Now I think that's in play. And the big question that is going to come out of the interviews today on Capitol Hill is how fast are we looking to move on interest rates, considering we are in an environment of basically full employment, very low unemployment rates right now. Economy is steaming up, and the Fed is going to be, they've already started to reduce the amount of tapering that they're doing in the marketplace, the funds that are coming in and actually buying treasury bonds. And how fast will we react? When will it be coming? And overall, if the market, the fact that interest rates are going up isn't necessarily bad news for the economy or for the markets in general. Ideally, lower interest rates always lead to higher markets overall. But if I'm talking about the movement of the Fed over the next couple of quarters, how fast will we be making that move? And I think that's what the marketplace is trying to gauge more than anything. We know that the interest rate increase is more than likely coming. So how fast are they going to react? And that's what the marketplace is trying to digest. That's why we've had some volatility in the S&P and the NASDAQ overall. We're seeing stocks that like higher interest rates do well. The S&P 500 index is made up of about 10% in the financial area, and that's kind of holding its own right now. So 10% of the S&P is being represented by financial stocks. And because of the financial stocks are doing well because of the increased interest rates, it's kind of holding the SPX up, if you will. But 30% is actually tech stocks. And we're seeing the NASDAQ kind of struggle in the tech stock range. Obviously, a lot more tech stocks in the NASDAQ than the S&P 500 index. But also in the S&P 500 index, the fact that 30% of the index is actually weighted in tech stocks overall has also made the S&P 500 index struggle as of late. So if we go and look at the charts in the SPX, we still have our ducks in a row. We still have a bull market. The 50-day moving average is not as strong as it used to be. We've been really struggling to hold that 50-day moving average, but we still like the fact that we have the 200-day below the 50, below the 20-day, kind of a fairly solid marketplace overall whenever we get our ducks in a row. Over down here where we broke down, we had to break down all the way back in October. And this was actually considered, they call it a death cross, but when it's a slower moving or a faster moving average going through, I guess I don't put a lot of weight in it if we're talking about the 20-day crossing over the 50-day. And then it comes back here and we got the 20-day crossing over the 50-day to the upside here. That would be considered a golden cross. That actually did start a fairly decent rally in the S&P 500 index. But in general, it means a lot more when we see it actually cross through a 200-day moving average. Just puts a little bit more weight where you might have the 50-day or the 20-day crossing through the 200-day moving average, the real slow moving average that a lot of people like to look at. So what do we have going on in the S&P 500 index? We just have some chop. We have some chop. We have a little bit of nervousness in the marketplace. This was obviously a big down day from last week overall, but the NASDAQ chart doesn't look as good. NASDAQ has a little bit more chop overall. We do see that the 20-day moving average did do the death cross through the 50-day moving average. The 200-day moving average is in play here. This is an area that you could see the NASDAQ getting down to right around this 200-day moving average. We also have, this was the start of the real strong rally in October of 2021. And you see basically the NASDAQ went straight up. And usually when that happens, it adds, well, it doesn't really give it a good area to try to find some support for the marketplace. They have such a strong monthly, daily move up in the NASDAQ overall means that this little area right here is in play right around, and it's a nice kind of a round number, right around the 1500 level, right here with my crosshairs at the beginning of that rally. The market was at 14,963 in the NASDAQ. So around this 1500 level right here, or 15,000 level right here, that's kind of, we're looking at the 200-day moving average. We're hoping that the marketplace would get some support if the NASDAQ were to come down to that level. But we do have a good, strong update today. Okay, so story of the marketplace is value. People are looking for some value overall. So in the tech stocks, it's hard. There's a lot of buybacks that have been going on. A lot of people have talked about Apple and how many shares that they have retired. So the tech companies are going out and buying their own stocks, reducing their public float, and that has helped. In the case of Apple, Apple is one of the strongest of the FANG stocks right now. And a lot has to do with the fact that they have been had a very aggressive buyback program over the last year on their stock. Now, we're looking for some value in tech. Ideally, you can talk about the financials. Financials have done really well, but they've done really well. So, do you want to be buying in the financials at all-time highs across the board? If I own financials, I probably wouldn't. I'm just going to hold at this point in time, but I don't know if I want to add more to this position, to this lofty position in the financial markets. Now, we do see that 2% level. If you do think that interest rates are going to there, there's no reason to run away from financials overall in the 10-year. That would be a good sign for the market, for the financials and for the energy stocks. If we did if we did actually break out on the interest rate chart that we were looking at. And we do, by year's end of 2022, we see that we're a little bit closer to that 2% level overall. Okay, so let's look for some value in the tech stocks. We talk about Micron technology. I'm going to show you a couple of charts here, but there's something really interesting that has gone on in Micron technology. Now, first of all, we talked about golden crosses, and we do actually have it on the 200-day moving average. So means a little bit more to me. We had the 20-day breakthrough at the beginning of December of last year, and just recently the 50-day crossed over, had a golden cross in over the 200-day moving average at the end of December. The high, the previous high was back in April of 2021. We actually broke through that, but we're kind of struggling a little bit. And for some reason, I was trying to go all the way back to 2000, and I couldn't quite get my chart to go there. I have a little bit of a data issue going on. So I'm going to run to Yahoo Finance. And I just want to show you that going all the way back to 2000, look at this high in Micron technology. Now, very interesting move. That was talk about climbing a mountain all the way back in 2000. A huge run up. Now this is a weekly chart, so the bars are going to be are going to cover bigger time periods overall. But we still have a very strong movement up in Micron technology. We're at that level. We've actually broke through to an all-time high for just a second. Now we came back down. So we're struggling. We've came up and touched it once. Now we're going back and touching it again. The more times you approach that resistance level to the upside, the more likely that if you do break through, that it's going to be a very solid move to the upside. So the fact that we've had a couple of touches already on this level that goes all the way back to the year 2000 is just interesting in general. And we're back to the Ally Invest chart right here. So there's a couple of ways that we can look at it. We see this volatility in Micron technology where we came all the way up, touched the 95 level, went all the way back down to the 65 level, driven all the way back to the 95 level. At this point in time, it's a strategy that I don't talk a lot about because it's a very speculative strategy for the stock play of the day. And that would actually be a long straddle, where I'm going to buy a call and I'm going to buy a put. I'm going to go up maybe a month in time. You're going to have to pay up for it in Micron technology. But let's just see, do we break out to the upside and set a whole new range for the underlying stock? Or do we come back down to the 65 level? The last time that we were at 65 was October. So basically 3 months ago when we went back and looked at that range, that was from 60, that's a 30-point range in Micron technology. So I just want to make sure that I don't pay more than 30 points for that straddle. And that's what I want to look for in that type of move. Now, that's not going to be the stock play of the day. I like to mention it, but I'm not really a big straddle fan overall. So what we're going to do today is we're going to actually use a strategy that we're going to use a long call spread. We haven't talked much about long call spreads. We're going to manage our risk. We're not going to just buy an option outright and hope that we get to break out because we haven't really established it. But we're going to put on a position that could benefit if we get a breakout to the upside. So that strategy is actually going to be a long call spread, right? So I've given you a lot as far as option trading is concerned. We talked about a long straddle, and I can even highlight that in here under the, let's look at the long straddle. I prefer to do a straddle than a strangle. I'm going to be buying at the money option contracts, buying at the money call, and at the money put, looking for a big move in the underlying stock. That would have been the long straddle. The official paper trade today is going to be the long call spread. And with that said, because we have two different strategies, please make sure you put your questions in the chat box. I'm going to go over the actual paper trade for this week. And while I'm doing that, if you have some questions, please put them in the chat box. This is a very interactive show here on the Ally YouTube channel. And we love to get the listener questions, and I'll try to address as many of those questions as possible. So, long call spread. If I run back to the Ally Invest option chains, the time period is fairly important when we're looking at a long call spread. When I look at Micron technology, one of the things that I do like about it is that a couple of things have happened. They're still trading at a fairly low PE relative to the industry. Right now, the earnings per share is at $8, almost $9 overall. Very strong growth rate in earnings. Right now, we're looking at the growth rate at about 37% as far as earnings are concerned on a year-over-year basis. They decided to start paying a dividend, and I can kind of highlight this. Well, I'm not going to highlight it. We'll leave it right there. But overall, if you notice, way back in the day, they used to pay dividends. Right now, they just started paying a dividend again, and they brought that out. So they have cash on their books. They're willing to share it with their stockholders. So as far as looking in technology and seeing a lot of trials and tribulations with a lot of the stocks overall, we're just trying to look for a little bit of value on a stock that has a potential chart wise to break out. Now, none of this is meant to be a recommendation. We're just trying to learn here on the stock play of the day. And my biggest thing is if we look at a chart and we're trying to diagnose a strategy that will work based off of what the chart is telling us, that's what I want you to take away from this. I want you to be able to take this, apply it to your own methodology of investing, and maybe see where this strategy might fit into a similar situation. So in this situation, when I'm doing long call spreads, I don't want to go out that far in time. So if we're looking at a 10-day contract or a 17-day contract, when you're doing a long call spread on a kind of volatile stock, I mean, it's a $93 stock. It's not that expensive overall. We're trading at about a 36% implied volatility. That isn't horrible in this marketplace. So they're not too expensive. But if I'm doing that, I still need the fact that I'm going to be selling one option contract and I'm going to be buying one option contract. So the one that I'm selling is going to be working against me as the market goes up. And the one that I'm buying is going to be working with me as the market goes up. Overall, let's hope the market goes up. Let's say it that way. But if I'm doing this trade, I need this option contract to wither away if I'm correct on my forecast. And how does it wither away? Well, two things can happen. Implied volatilities can come down and decrease in price, or we can have time decay. Fairly expensive option, selling a 97 strike. It has $1 in time premium. This is the 10-day contract. You want to give it a little bit more time? I don't mind looking at the 17-day. Overall, I'd probably keep the strike prices just about the same, but I would look at a 17-day just to have more time to play out. But when I'm looking at long call spreads, the time frame that I'm picking is very important because of all the things that I just mentioned. So for the paper trade today, it's going to be a speculative one. We're going to only give it 10 days to live, and we're going to look at hopefully getting a little bit of a breakout from the marketplace. Maybe we'll get a little bit of upside today after Chairman Powell gets done talking, and we can keep this momentum in the marketplace overall. And hopefully that can drive some of the tech stocks higher. And Micron technology, we're really just looking for some value in this sector of the marketplace. So I'm going to scroll down. And right here we see we're going to go 5 points wide. We're going to manage our risk. So in my goal of setting up a spread where it's almost kind of a FOMO trade, where I have fear of missing out, where I want to take on a position just in case an event happens, I like to give myself a little bit more upside than I have downside. So I picked these strikes, went a little bit in the money and bought the 92 strike sold the 97 strike, we're paying about 2.25 if we can get the midpoint on this long call spread. And if we do that, we have a 5-point wide spread from 97 down to 92. We're paying 2.25 for it. That means we have $2.25 of downside. That's our maximum risk on this trade. What we pay for it for every 1-by-1 spread that we put on, or $225 plus commission. I always got to add commissions in. And on the upside, we have $2.75 worth of upside. Now, if I set up the trade this way, I don't mind just letting it ride and see where I'm at 10 days from now. See where, if obviously, if I get the big move up right away, I want to take my profits and move on. But I'm managing my risk by setting up my spread in a way where I have more upside if I'm correct on my forecast and less downside if I'm incorrect on my forecast. And that's one of the wonderful things about option trading is that you can craft a strategy to try to fit your forecast and help you manage your risk. Now, to me, long call spreads isn't necessarily about managing the risk and understanding everything that goes along with the long call spread. It's about picking that expiration. And we're specifically looking at a chart, hoping for a breakout to the upside. This would be the beginning of the trade. I would possibly put this trade on. And if I did get that breakout to that 97 level, think hard about maybe just buying the stock at that point in time. So this is one way to take that position that could lead to another position if you're correct on your forecast overall. But I'm going to manage my risk to start with by putting on this trade the way that I am. The concept would be that if we did get that breakout to the upside, I might go out and buy 100 shares of stock and hopefully just be long Micron technology going into a year where the Fed's looking to increase interest rates and could be a tough place for the marketplace. So we're looking for some value in a tech stock overall. All right, so let's put it in the right rail, and then I'll show you the profit and loss calculator. But here's the official paper trade for this week's stock play of the day. We're going to be looking to buy the January 21st 92 strike call. You remember, now you could go on out and go another week out in time. I don't mind that at all. It's because the timing is so important on long call spreads. And then we're going to sell the 97 strike call option with that same expiration. Looking to do it at the midpoint. You can never guarantee a midpoint fill, but we'll call it $2.25. So net debit of $2.25 to your account, or $225 plus commission would be the total cost of that trade overall. All right, so let's look at the profit and loss graph. And then make sure you put your questions in the chat box. Willing to answer them at the end of the show. We'll make sure to save some time for that overall. All right, so let me close this up. And if we look at the long call spread inside the options playbook, optionsplaybook.com, we see that this is a strike that we're buying. We're centering the stock right in the middle of this. And usually, if you go about equidistant in the money and selling equidistant out of the money, like, for example, in our example here, where is the underlying stock at exactly? Let me go grab it real quick. So we have the underlying stock trading at 93.66, and we're going down a little bit in the money, and we're selling a little bit out of the money. And when you do that, you can usually manage your risk so that you're buying the approximately the same amount of time premium that you're selling. And that's where you can get your risk reward exactly where you want it at. Like, for example, we want to pay 2.25. We want to have $2.75 worth of upside. Now, if I want to adjust that and I want to pay less, well, then I'm going to need the stock to go up more in order to get that maximum payout. So if I went up and strike to the 93 strike call that I'm buying and I sell the 98 strike call, right? I can reduce this overall cost of this trade, but then I need the stock to get up to 98 to get that maximum upside benefit on that trade. So it's all about that trade-off on that risk reward. But if you're only willing to risk $1.75 or $1.50 on this trade, well, then that's one way that you can do it. That's one approach that you can take on it overall. Okay. So long call spread, underlying stock is here. We're buying the in the money, selling the out of the money. Obviously, at expiration, we want stock to be above strike B. If we look at the Ally Invest profit and loss calculator, what we see here is, and I'm going to zoom in on it, went the wrong way. Let's go one more plot. Okay. So here's where the stock is at. This is as of right now. And this is what I'm talking about. We have a $93 stock. We have a 36% implied volatility. There's a little bit of time premium in this option contract. So when we first start on this trade, if we are correct on our forecast and the stock goes to 97 right away, we just don't see as much benefit or profitability as opposed to if it happens closer to the expiration. So the colored line is as of today. And this is in theory, right? In theory, this is assuming that all the variables in the marketplace, like implied volatility and time decay, all stay relative as the market is going up and on the way down. So on the upside, this is a bad thing, that time component in that short option contract. But if I'm incorrect on my forecast, it's a good thing, right? So stock does come down to 92 or gets down to 91 and it does it in a hurry, I'm probably just going to get out of that trade because then the time premium is helping me. So it kind of gives me my land in the line in the sand on the downside, but I also have this reward scenario on the upside. So now if I change the days to expiration, we're going to see this graph morph in to the dotted line. I'm going to go all the way down to 0 days, which is actually 1 day on our calculator. And you'll see that now it's acting a lot like at expiration on the stock. We go to 2 days remaining expiration, it gets a little bit closer overall. So if I'm looking at this trade, the time frame is very important when I'm trying to forecast a potential move in an underlying stock like Micron. And today we're making our forecast more so about where it is on a chart basis relative to just the stock in general, even though we are looking for some value inside the tech sector. All right, so put your questions in the chat box and I'll see if I can address them. All right, here we go. 2022, by the way, Happy New Year. We did have one stock play of the day while I was out on the road and traveling for the holidays. So it's good to be back in the home office doing the stock play of the day once again. William says, good afternoon. Good afternoon, William. Welcome to 2022. Micron monthly chart looks really good. That comes from Montana. Wayne says, Happy New Year, Brian. Well, Wayne, it's always good to have a longtime listener, Wayne, back into the crowd. Does it matter if you time up? Does it matter if you time the trade on an up or down day? Well, in general, a lot of people would want to buy on momentum days. So if I'm doing a shorter term trade, I would prefer that the marketplace is up that day. So when we have a solid up day, usually more stocks are advancing than declining overall. Usually that is the case. And when that is happening, that means the market just has some momentum. So I prefer to have an up day. And in this instance, if you really think about it, we have the NASDAQ actually outperforming the S&P 500 index. We're looking at a tech stock. So overall, this is a decent day to consider this trade. And it is always good to even look at what does the chart look at on Micron based off of the NASDAQ chart and what's happening in the general marketplace overall. So then next, if I own the stock, what option strategy I have to use? Well, if you own the stock, there's a couple of things that you could do. One of the things is that one option contract that we own, that 97 strike that we're kind of targeting to the upside, you can sell a call against it. It's trading for $1 when we set up the trade. It's going out 10 days in time and you're receiving $1 or $100 for saying that I'd give up the stock at that 97 level. Now you got to be concerned about that because if you own the stock right now, you probably got a gain on it, right? Because we're very near that all-time high. And so you want to be prepared to be able to sell that underlying stock. But one trade that I would consider is looking at selling a covered call on that position. And in particular, that 97 strike that we were looking at as part of our long call spread might be an alternative on a covered call position. Now, If you've never done it before, you want to be willing to manage that position. So I'm going to run to the options playbook one more time here. And on the covered call situation, we have managing positions. Very good article. If you've never done a covered call before, or if you're dipping your toe in the water by doing it, rolling a covered call tells you how to manage a covered call position if the underlying stock actually gets to the strike price of the option contract that you sold. So this is a real good little short read and a real solid section talking about how to roll covered calls inside my book, The Options Playbook. And every word inside the Options Playbook is at optionsplaybook.com. Okay. Here we go. If I do a short strangle, I wouldn't do a short strangle, Wayne. If I did a long strangle on a MU, okay, you're saying you're going to sell the. Okay, let me. I'll just read all the way through it. I don't have my colleague with me today, so usually these are vetted for me. But here we go. Brian, if I do a short strangle on MU, selling the 88 put and the 100 call, how do I calculate my net delta since the put has a negative delta? Well, if I sell a put, it becomes a positive delta. And if I sell a call, it becomes a positive, or it becomes a negative delta. So, Wayne, are you saying that you want to sell it or do you want to buy it? Because the strategy that I was looking at is the long straddle overall. So I just want to make sure that that isn't a typo. Okay. Let me scroll down and see if Wayne is. I know Wayne's out there listening. If that is what where our goal was here. But if I go and look at the strategies, the strategy that we started that I don't mind in this scenario, 36% implied volatility on Micron, the stock has actually been quite volatile overall. It's been more volatile than what the implied volatility has been saying. And here is the long straddle where you buy the put and you buy the call overall. When I first put on the trade, your net delta should be close to zero, right? Depending on where the stock is relative to the strike price that you're buying, because you have one long call and one long put. So you have a positive delta and a negative delta. And so they're going to work against each other until one takes over. If you're correct on your forecast, the call delta would go up this way. If you got a big move to the downside, the put delta would then take command. And you would see that delta increase in price on a negative fashion if it went to the downside. Okay. Wanted to sell it since the IV is high. I wouldn't want. If I did that, Wayne, I would look at doing an iron condor. If you wanted to sell volatility in this situation, I don't want to get too far down the rabbit hole here, but I would look at maybe doing a iron condor and going out of the money, selling an out of the money call spread and selling in way out of the money put spread overall. That's the way I would look at that. Okay. So enough said on that topic. Our strategy today is the long call spread, and so let's try to keep it where the focus is. Okay, could you cover the rules you would use to govern your exit on this trade? If it goes up 100%, close it. If it backs up 50%, close it. And how? Okay, so the question basically comes, what are your goals if you're putting this trade on? How are you going to manage the trade? First of all, I tried to emphasize this when we were setting up the trade. We are already managing the trade by doing the spread. We're not buying an option outright. And because of that, we're managing our risk. We're selling an option contract, lowering the price of the call that we bought. We have a net debit that is smaller than if we just bought the 92 strike option outright. And so we are giving ourselves $2.75 worth of upside on our 5-point wide spread. And we have $2.25 worth of downside on my spread. So I don't mind that you just let this ride. Either it lands somewhere in between those two strikes, or if it goes down, that's my maximum risk. I just don't want to over leverage the position. We're talking about a 1-by-1 spread here. You have to decide the number of contracts that you would be willing to do. Now, with that said, I also don't mind the concept that if it did come down to my strike and it came down fairly quickly, in this instance, you get a little bit of a buffer. You would be long an at the money option contract. That's where your time premium is at. So maybe I close out the trade if it comes down to that strike in the short term. And then I kind of let it ride on the upside. So now, how would I do this trade? Our maximum upside is $2.75. If I could sell this for maybe $4.50, that last 50 cents is kind of hard to extract because of the time premium that always remains in that short option contract. So I might put in a good till canceled close order to get out at 450 and take the bulk of the profits on the upside. And then say to myself, set an alert on the stock. If it comes down to the 92 strike, if that happens, then I'm going to close out the trade on the downside. Now, it would matter to me when it came down. It's only a 10-day trade. But if it did, then I'm going to manage my risk a little bit more on the downside and kind of let it run on the upside, if you will. So those are two different plans. You have to decide which way you want to take that approach. I'm okay with either of them, but then I want to be consistent in how I approach all of my long call spreads overall. All right. Late, but made it. Okay. All right. Good, William. Nice to see you. Mohammed, how to manage the trade? We already did that. Wanted to sell it since there's high implied volatility. Okay. Looks like we've covered all the questions. And if I look at my watch, we're a couple of minutes late. So thanks for coming to the Stock Play of the Day 2022. Please let me know. Give me any feedback that you might have. My email is theoptionsguy@invest.ally.com. We're going to be building out this show a little bit more in 2022. We've got a lot of good feedback overall about the program. If you want to follow along with us, this Friday, I'll be back doing the Stock Play of the Day overtime. Something should be happening in Micron by that time. It's a fairly volatile stock, so we'll see how we might adjust that trade on Friday. And then Tuesday, we'll be back doing another Stock Play of the Day. Click subscribe, ring the bell, and you'll get all of the alerts. Thanks for coming, everyone.